and the inverted yield curve tell you where mortgage rates are headed? Imagine trying to predict the weather next week by looking at the clouds today. It's not perfect, but it can give you clues. The same idea applies to the inverted yield curve and mortgage rates. The inverted yield curve happens when short-term interest rates are higher than long-term rates. Usually, long-term rates are higher because lenders want extra compensation for locking in their money longer. When this flips, it signals that investors expect the economy to slow down or even enter a recession. Mortgage rates, especially for 30-year fixed loans, tend to follow the yields on long-term government bonds like the 10-year Treasury note. When the yield curve inverts, it suggests that future interest rates might fall. This can put downward pressure on long-term bond yields, which could lead to lower mortgage rates. But it's not that simple. Mortgage rates include a spread above Treasury yields to cover risks like borrower default and market fluctuations. During uncertain times, this spread can widen, which might keep mortgage rates higher even if the yield curve inverts. Research shows that as the yield curve becomes more inverted, the expected duration of new mortgages shortens. This means lenders see mortgages more like short-term assets with yields above the 10-year Treasury. When the curve steepens again, mortgage durations lengthen, and rates tend to rise toward long-term bond yields. So mortgage rates don't always move exactly with the slope of the yield curve. They are influenced by how lenders view risk, economic outlooks, and market conditions. For homebuyers, watching the yield curve can give hints about the future direction of mortgage rates. If the curve inverts, it might signal rates could drop, but volatility is also common during these times. It's wise to consider other factors like inflation expectations and Federal Reserve policies. If inflation is high, it can push mortgage rates up regardless of the yield curve. If the Federal Reserve raises interest rates, mortgage rates often follow. For Asian American homebuyers and investors, understanding this relationship can help in timing when to lock in a mortgage. When the yield curve inverts, it could be a sign to watch for potential rate declines. But it's also smart to stay alert for sudden changes in mortgage spreads and market sentiment. Choosing between fixed and adjustable rate mortgages depends on your outlook. Fixed rates lock in current levels, while adjustable rates might benefit if rates fall. Keep an eye on the overall economic signals, but remember that the yield curve is just one piece of the puzzle. In summary, the inverted yield curve can give clues about where mortgage rates might go, often indicating potential declines. Still, other factors like market risk and economic conditions also play a big role. Using this information along with other indicators can help you make smarter decisions when financing your home.